Welcome to Tony at 12. Today's In Conversation is about the global financial situation, and my guest is Toby Birch, who is a Senior Investment Manager at Gower Financial Services. All opinions are personal and no investment advice is being given. Toby, good to see you.
Good afternoon, how are you?
I'm good, thanks. Yourself?
Fantastic, good, thanks.
Certainly 2020 was a year and a half, wasn't it, in terms of what happened on the markets? And we're going to sort of have a look down and take a view at the various points that occurred. But first of all, we all know about the FTSE 100 and the FTSE 250, they're indices, but can you explain how they're actually calculated?
Sure. If you take the FTSE 100, you might think, oh, it's 100 companies, therefore have 1% in each. But that doesn't really represent what's going on the ground. So the biggest firms have the biggest representation. So the oil majors like British Petroleum, Royal Dutch Shell, a larger percentage of the market. So when oil's having a bad time, the FTSE will be having a rough time too. And likewise in America, if the tech giants are doing well, the S&P 500 index will be performing too. Yeah,
so essentially then the indices track the situation with the ups and downs of the market.
That's right. It's a collective view of all the major companies. You mentioned the FTSE 250. That's the next rung down. So the companies below the top 100, the next to 250, sort of medium-sized firms. And it gives you an idea of what's going on more domestically in Britain, because the FTSE 100 is dominated by large overseas earners. So it's not necessarily a representation of the UK itself.
Does the 250 include the 100s?
No, it doesn't. That's a separate index.
Right. Okay. So everything is separate from that point of view. Okay. Sorry, I'm moving around a bit because my chair's got stuck. Yeah. So, from your point of view, as an investment manager looking at the UK, you'd prefer to go for the 250, yeah?
Personally, yeah. It depends what the mood is. When you have a weak pound, it's the international firms that tend to do better. But if you think there's going to be resurgence post-Brexit, then for me, the UK sort of medium companies are the place to be, because the pound will be stronger. These are more domestic type of firms. So yeah, that would be the favoured area.
So following the crash of 2020, I suppose the nearest recent comparison was 2008. I did a little bit of research on the FTSE 100. In 2008, it went from 6,456 down to 4,434 as the bottom line. And in 2020, 7,542 to 6,460.
Yeah, so you've got to remember that the 2020 crash was over 1 month. So in that case, the market fell a lot more. It was down 34% at one stage, and it's since rallied back up. So comparably, it's a little bit worse than 2008 in percentage terms.
But 2008 presumably was the equivalent of a slow puncture over that year.
Yeah, it was. Yeah, it's like a stagger than a slump at the end. I remember it well.
Now, looking at 2020, some of the big companies took a massive hit, didn't they? IAG, who's the parent of BA, down 61%.
Sure.
Yeah.
I mean, this is what we call, commonly referred to as a K-shaped recovery. It might sound a bit strange, but everything fell initially, and then some companies took off, and some bombed out, like British Airways owner, for example. So it's a real complete diversion of firms for sure.
I've heard of huge recoveries, U-shaped recoveries, V-shaped recoveries, but what you've just shown me, I don't think actually applies in mathematics, does it?
It's K for kicking, I think it's a recovery.
So there we are. Now, obviously, with the situation, a lot of dividends have been substantially reduced. And of course, a lot of pension funds rely on dividends.
That's right.
Yeah.
Pension funds being hit from both sides, because the traditional low risk investment for government and corporate bonds, the yields or interest rates are negligible or negative in some cases. And as you say, the one safe haven for income from stock markets, again, has evaporated. And
Yeah.
traditional stalwarts like the energy companies, we saw crude oil completely bomb out at one stage last March, to the point where you had to pay people to take oil away from refineries. I've never seen anything like it. But crude oil's back above $50 now. So those income streams will come back, but overall you have much less choice of where to get income from. It just makes any income portfolio much more concentrated and possibly higher risk than it used to be.
I mean, presumably the oil companies are going through a phase of getting bombed out, aren't they, in terms of demand for their product?
Yeah, I mean, you've got to remember that Asia's the real driver for future demand, and the likes of China are just, they're due to grow by about 9% this year, and it's as if nothing has happened. So yes, one side of the equation has dropped out, but on the other side in Asia, there's still plenty of demand. And a lot of these oil companies are also rebranding into alternative energy firms as well. I think BP want to make themselves carbon neutral by 2050. How they do that, I don't know, but that's their goal.
They've all of a sudden tried to add a dash of respectability to their situation.
Why not?
I mean,
it's called greenwashing. I think we're all at it at the moment.
But obviously they've got the resources to do that. Yeah. I mean, we can remember British American tobacco, for example. When cigarettes went off line, they went into financial services, didn't they? Bought Eagle Star.
Yeah, people should talk about tobacco being the bad stuff for the last few decades, but Ultra has been one of the best performers as well. It's all very well to get caught up in making things more sort of compliant and more sort of correct, as it were. But these stocks, although they're sort of labeled bad stocks, keep on performing, and you've got to ask yourself, where do you want to be in future?
Now, can we have a look at the various sectors that were hit? Equities, obviously, we've just said, took a pounding. They, in turn, presumably, we see the commercial property sector in the equities as taking a hit. And they're both directly affecting the high street, aren't they?
Yeah, I mean, obviously the high street and commercial property are part of that downward part of the K shape there. And you've got headlines of Debenhams and all sorts of retail firms being hit. So yeah, it's quite a grim environment. And commercial property is one that's often heavily leveraged. There's lots of borrowing behind it. And as soon as the income stops, the mathematics falls apart. And the same with private equity. We're talking about British Airways and the like. These are very heavily geared companies, which are very sensitive to stock market declines and also business downturns. So the way from here is very unclear for property markets. But yeah, it could be that there's a lot less commuting in future, either international or local, and we kind of get stuck at home pretty much. I mean, fortunately, Channel Islands, we're very lucky not to be, but elsewhere, particularly Western countries, there's a much more sort of dictatorial atmosphere to stop people moving around.
So where do you think that puts the City of London in terms of the commercial property aspect?
It looks like yields, the prices will have to drop, and because yield and prices are inverse movers. So same with bonds as well. So as the price of property goes up, you get less and less rental yield. But as the price falls, the income you can get will improve, assuming the tenant pays, obviously. But that's just a natural rebalance, if you like.
Yeah, but you don't often see it happening on block as we're seeing it now, do you?
Yeah, you're right. I mean, I'm still pretty positive for London as a financial services centre for the future. I mean, it's just incomparable for foreign exchange and sort of cutting edge, financial services. I don't think we've had some project fear and maybe project fantasy as well where Brexit's concerned, but the UK has just been a standout financial services centre. And so while I'm not feeling about the City of London, sure, commercial property there is definitely going to go through some harvesting, if you like.
Yeah. Okay, so that looks at equities, particular reference to commercial properties. Fixed interest, gilts, which is government borrowing.
Yeah.
Good for the government.
Well, the thing is, you might think, oh yeah, they're going to spend less because less interest, but the automatic temptation, it's like increasing the credit limit on the card. They just keep borrowing more and more. And we've now got over like 2 trillion of debt in the UK, which is the worst level in peacetime relative to the economy as a percentage. So I think what the kind of surprise element in 2021 will be some kind of reset of the bond markets. And this has happened in the past where government debt's been kind of swept up and repackaged and pushed into the future in what's called perpetual debt. And we're going back, after the the South Sea bubble, almost like 300 years ago, exactly the same thing happened. So I think we are due for a big reset in bond markets, and what that does for equities, it could surprisingly be very positive because so much money is tied up with bonds. It's about a 3-to-1 ratio of bonds versus stock markets. That money leaving is just going to be a wall of money hitting equities, and that's not like a flag waving stockbroker thing to say. It's just nowhere to go for this money.
Am I right in thinking Austria have recently issued a 100-year bond with negative interest?
Yeah, I mean, the reason that they're getting rid of negative interest is that people are so scared of keeping their money in the bank, because instead of the old-fashioned bailouts we had in 2008, we now have legislation for bail-ins, which means that customer deposits can get confiscated above a certain amount, as we saw in Cyprus some years ago. So yeah, keeping cash in the bank it's not money in the bank anymore. It's it's money at risk, and this is why other assets are so favourable, like cryptocurrencies and gold and anything which isn't on deposit.
But having said that, the thought of buying into a bond 100 years, would that bond actually get into a positive situation in terms of its capital value?
I mean, the price could go up potentially if there's a flight to government debt, but really last year was I think the last time we'll see that flight to government, because the background to all of this is a loss of faith, and we've seen this down the decades, most notably in Germany in the 1920s when they had hyperinflation. And faith is a very nebulous thing, and once it's gone, you get prices surging, and obviously that's inflation. Inflation is very bad for the bond market. So I think the era of faith in government is we've passed that. We've passed that for good, I think. And this resetting of bond markets by the governments, they'll never be able to borrow again. Potentially, it's that severe.
With this perpetual situation, of course, they had it also with consols, didn't they?
Yes, that's a similar word for. Consols are short for consolidated bonds. So exactly the same thing. All these things get a rebrand every time they have to redo them. It's all very euphemistic, and no doubt these will be called, freedom bonds or something. Who knows?
You were saying just now about people worrying about where to leave their money. I was reading a little article by Paul Lewis, who does the BBC Money Box programme, and he was talking about premium bonds, which we know are safe in terms of the fact you don't lose the capital value. But he said from an interest point of view, which is what the prize is, unless you're a UK high rate taxpayer with the maximum 50,000 in, he just didn't think it was a sensible place to be. But equally, he didn't say where else to go.
So anything below interest is going to be potentially decimated by inflation going forward. And this loss of purchasing power is part of go back in history. This is the reason why we had this Marxists fighting the Nazis in the 1930s, and obviously Nazis got to power, but it was a close run thing between the two. And the reason for that is because money got debased, had hyperinflation, so middle class people had lost their pensions, the pensions were worthless, and they lost faith. And that's when extremists sound very appealing, because the mainstream government has failed. So this is a very good history lesson to bear in future, that you start tampering with the financial system and keep on printing money, then it's just like Buckaroo. At some point, it just gets too much and falls apart. So that's my main fear.
But this could happen, couldn't it, with COVID?
Very quickly. I mean, what's happened is that you've got you've had a huge burst in money supply going up the charts, but inflation is just flat as ever. And the reason for that is that the velocity or spending of money has ground to a halt. And I liken it to pumping a patient full of blood. If the heart's not working, then nothing happens. But as soon as that velocity picks up, then the inflation numbers will get very severe, I believe.
How high do you think it could go?
It could easily go into double digits, not beyond. And often it's the prices itself. It's not about printing money. It kind of goes back to this loss of faith. And in the Weimar Republic in 1920s Germany, it wasn't the physical printing of notes. It's just the fact that people didn't trust them anymore. So the government at the time started printing only on one side because they couldn't print the money fast enough to keep up the prices. So prices shot up and the money printing came after, and it kept trying to keep up, but the faith had gone.
Looking at it from the point of view of 2020, it's affecting the whole world, whereas the Weimar Republic was just Germany. Does the fact that the whole world's in it create a different situation, do you think?
Caveat that, I'd say Russia and China very specifically stepped aside from this. So you'll notice across Western governments, there's talk of Build Back Better, green projects. It's all very coordinated. And there's a master plan behind this called the Great Reset, which is well documented. It's part of the World Economic Forum's idea of resetting the world economy into this sort of utopian design. Something we've never voted for, but that's on the way. But China and Russia don't want to take part in money printing. They don't want to be part of this grand reset. So they're setting their own course. And what we'd like to see is that China is going to become the leading world economy sooner than we think. By default, their currency will be the leading one. And both China and Russia are trying to get away from the international payment system called the SWIFT system and set up their own method of transacting business.
I look at Russia as being comparatively weak compared with China. That's
true. Yeah, they're kind of aligned, not on. Not so much from a communist point of view from their past, but just it's not the USA or not the Western Bloc, and so they're looking to peel off. It does have this end of empire feeling where America is concerned. You remember from Roman history how empires collapse from within. You've got internal fighting, and you've got half the population vehemently opposed to the other, whichever side you're on, and this is very unhealthy. What it does, it creates a vacuum internationally where China's expansion can just fill up that vacuum, because they've already been working on the new Silk Road project for years, spreading influence among developing countries. So it could be a return to where China was 200 years ago, with a third of the world economy under their belt.
That example you gave of countries, democracies splitting, we're seeing it in the States, aren't we, at the moment?
Yeah, sure. Sadly, very sad.
Yeah. Looking at other investment points, gold.
Yeah, gold's been a bit disappointing this year. I mean, we had a run up in July, and people like to say gold's behavior is all about safe haven asset or inflation. That's part of the story, but it's really driven by the level of inflation versus interest rates. So when interest rates are very low and inflation's building, that means that cash has been effectively dissolved. Purchasing power has been whittled away. So you need to keep assets in money in gold and silver, for example. Not all your assets, but a portion, or related mining stocks, which we use for clients. And it's not waving a flag saying gold is everything. It's just part of a jigsaw, and it's something you need as a bit of a backup to act differently from other assets when inflation comes.
With the market, say you reckon to be 3 months ahead of the game, something like that. Does that still apply?
Yeah, it's quite weird. It seems somehow a bit inappropriate when, for example, in China and in Western countries, when the virus was peaking and just plateauing, and most people were dying effectively, that's when markets start to rally. So it seems very inhuman sometimes, but it's just like a combine harvester sucking up data and churning forward, always looking ahead. So yeah, it sometimes seems completely inappropriate, but just it's not a human thing. It's just a collection of views on where things are going. So you've got to stand aside and say, what is the market telling me, even though it just seems quite bizarre sometimes.
Yeah, but not necessarily taking it totally on board. In terms of your job, it's a bit of gut feeling as well, I guess.
Yeah, there's a lot of experience personally from
Yeah.
studying histories and cycles. I mean, we do tend to have too many mathematicians in markets, so they tend to be very linear thinking, and they can't really cope with things like you have a big crash or a big surge in markets. And again, it's human nature. We are still cave people at heart, and having these major seismic shifts is not part of our day-to-day understanding. So the more you study history, the more you look at these big changes, the more conditioned you are to accept them and just live with them when they come along.
Looking back to 2020, we saw some pretty spectacular recoveries, didn't we? Thinking about the COVID, the vaccine, that was the most recent one. That really shot up as once that was announced.
Yeah, it's really the biggest recovery was from the bottom of March. 23rd of March was the base, but the vaccine brought in a strange, almost like inversion. So
yeah,
at one point tech was struggling, and all these sort of assets which to do with home working, and the sort of dirty old-fashioned industries like energy and banking all kind of really spiked up on the back of this. So there's an assumption in prices at the moment that things are going back to normal, which is why the likes of the FTSE 100 has been a spectacular performer this year, funny enough. But I think maybe markets have jumped the gun in this case, because unlike China, you just can't roll out these vaccines that quickly in Western countries.
What about Brexit, the effect of Brexit? Did that go roughly as you expected?
Actually, slightly better. I mean, typically you'd expect more retaliation. I know you've had newspaper stories about ham sandwiches being confiscated in truckers' vehicles because they don't comply. But on the whole, I think be smoother than people expected. But I mentioned before about Project Fear versus Project Fantasy. I think the reality is that things will continue pretty much as before, and we'll adapt. But there's a lot of vested interests both sides, and sometimes you've got to close your ears and say, what's the market telling me? And the most immediate reactor is sterling itself. And we've seen the pound on a bit of a tear recently. So that tells you it's looking reasonably good for the UK. But maybe the vaccine euphoria is a little overcooked too soon.
Now, can you explain to the viewers in very simple terms how a unit trust works?
Yeah, I mean, if you go to buy a single share in a stock market, it'll cost you a good, hundreds or £1,000s to overcome the commission involved. Otherwise, it's not worthwhile. So what unit trust is, it's like a shopping basket where an investment manager gathers different shares together, and through economies of scale, make it much cheaper and more actively managed than just trying to buy it yourself or follow an index like the FTSE 100 through these tracking funds.
And the value tends to be calculated daily?
That's right, yeah. You with these trusts, you create something called the net asset value. So it's the value of the shares combined after costs. And you have different funds that are closed end, like investment trusts in the UK, for example, but unit trusts tend to be open-ended, which means money ebbs and flows very easily every day.
And from your point of view, you then enhance it a bit further by running a system where you've got lots of unit trusts on a fund platform. Yeah,
so you try not to over diversify. Again, I'm liking it to being a restaurant where you've got a menu. You don't order every single dish. You try and cherry pick a little bit, otherwise it's just a gloopy mess. So yeah, diversification, A, through a fund in one country, and B, through funds in different countries or markets is a good thing, but you can overdo it. So we tend to keep it down to about 10 to 12 funds for international portfolios.
And you're able to effectively work out what the risk is as far as the investor is concerned.
Yeah,
so you know, you will tailor it.
Yes, yeah, so different clients have complete risk profiles, and they come out to 1 to 10, and then you match the portfolio to make sure that they're not in something which isn't suitable for them. So some clients are 10, like myself, and will buy technology and gold mining funds. Others, it's just not their cup of tea. So the regulators are very, very strict on making sure you've got evidence for how you came to a conclusion of how clients came to be in that portfolio. So we take the risk profile of the underlying funds, much like the FTSE 100. You have different components, and you package them together to make sure that they match the client's risk profile.
But you know, as an investment manager, you are able to adjust as you go along. So if you see something happening that looks as if it's either going to be good or bad, you try and preempt it.
Yeah, that's harder than it sounds. So, for example, in March, you'd say, oh, you could have seen the crash coming because of what's going on in China, cash out, and then reinvest at the bottom of the market. But you've got to get two decisions exactly right at the right time. So you've got to get out, then pick a point to get back in at the bottom. And very few people got that. And some people get one stage right and go to cash and be left behind. So for our technology assets, some of these have risen about 80% from the bottom of the market. So even if you're in cash, thought, oh, I'm safe, I'll pick a bottom. And actually it starts to rise and rise, and you think, well, hang on, I'll wait for a correction, and it never comes. So it's better to stay invested, but adjust where you can. So for example, sometimes you can fine tune things when fund managers are going off the boil, or their funds get too big and they lose focus. So it's a tricky one, but it's very doable. Yeah.
It's a funny old business, isn't it, really? Because it's based on fear and greed, some people say. And in terms of getting
decided at the wrong time.
Okay, in conclusion, Toby, what are your hopes for the future? How's 2021 going to pan out? And this is without prejudice.
But I think it's kind of a hope and fear on one. I think this is the year when stock markets may well melt up like in 1999. And that's not necessarily something to be overly cheerful about, because after big boom, comes the pain. I'm more concerned about the direction of travel politically for Western governments, and how there's a more distinct left-leaning and controlling tone. And that I find pretty disturbing. But that doesn't necessarily mean will affect markets in the short term. In the short run, we'll get a big flow of assets into equities, out of bonds, and that could go much higher than we think. And then we'll look at 2022. We'll just try and cope with that as we can. But for now, positive on markets, less so on real life.
Toby, thank you so much. Really enjoyed talking to you as ever. That's Toby Birch from Gower Financial Services, telling us what's going to happen in 2021. Thank you.